Hi everyone, this is Dan Murphy at Aprio. I want to thank you for joining us today for this webinar on the impact of the 20% pass-through deduction on the real estate industry in general. Before we get started, I want to share with you some housekeeping notes. To receive CPE credit for this webinar, you must answer 3 polling questions, one at the beginning, one in the middle, and one at the end. If you have any questions during the webinar, please submit them through the question dashboard and we will answer them at the end of our presentation as time allows. If there are more questions than we can get to, I'll be glad to email separately to make sure those questions get answered. Now let's get started. So just kind of looking at how we're going to approach this. We're going to start off with the operational rules. We'll move into what income qualifies. Then we'll look at the availability of aggregating various businesses. There's limitations based upon your W-2 wages and qualified assets, and we'll get into what those mean. Then we'll do some pulling it all together, looking at a quick example of how this is going to work, and then also I want to give a quick update on other provisions as they relate to real estate. Okay, so the 199A pass-through deduction is probably going to be the biggest impact on the 2018 tax returns moving forward, especially as it relates to real estate developers, investors, construction industry. And this is a 20% deduction on domestic. Notice that it is domestic, so foreign investment does not qualify. Domestic qualified business income from a pass-through entity. Now, for purposes of the rule, they do consider a sole proprietorship a pass-through entity, but we are also talking about partnerships, LLCs taxed as partnerships, S corporations, and sole proprietorships are the 3 major categories that will qualify. What this does is reduce the top rate of tax on qualifying income from the highest current rate of 37% down to 29.6%. The reason this was enacted was because the corporate tax rate was lowered from 35% down to 21%. Now, corporations also pay a 20% tax on the dividends that they pay. So had nothing been done, a shareholder in a corporation would have paid 21% tax on the income from the corporation, plus an additional 20% tax on the remaining income that could be distributed to them in a dividend, to have an effective rate of 36.8%. So Congress enacted this pass-through deduction to keep the benefits of the partnerships, S corporations, and sole proprietorships, and prevent the need for businesses to do complete reorganizations because of the Tax Reform Act. A couple other things to note. The deduction is not an adjusted gross income deduction. It will come after that when you look at the 2018 tax returns. So various deductions that in the past were limited by AGI, they are not going to be limited by, they're not going to be further limited by this deduction. And this deduction also applies to both the regular tax and the alternative minimum tax. So there's a couple limitations that you have to know about. The first is the deduction is limited to the lesser of either 20% of qualified business income or adjusted taxable income. So adjusted taxable income is taxable income plus capital gains. So capital gains get added back, or I'm sorry, it's taxable income in excess of capital gains. So the purpose of that is that you do not get a 20% reduction in your capital gains rate. That's already taxed at a favorable rate, so you don't get a further deduction. So that's the first limitation. And then the next is you have a wage limitation and an asset limitation. So you have 50% of wages paid with respect to that business, or 25% of the W-2 wages plus 2.5% of the unadjusted basis immediately after acquisition. That was the provision that was put in order to get Bob Corker's approval to vote in favor of the Tax Reform Act. And himself being a real estate developer, he realized the benefit of having an entity that has very little wages, if any, but has very high capital needs to acquire businesses. The one thing to point out is it is unadjusted basis immediately after acquisition. We'll talk about it in a little more detail later, but really that's just looking at cost basis. So this is not your adjusted depreciable basis, it is original cost. So they couldn't make it that easy. They had to add in more provisions. And the first one that they put in is that if your taxable income is below $315,000 for joint filers and $157,200 for single filers, then the W-2 wage limitation doesn't apply. Now, if it's between $315,000 and $415,000, we'll look at just the joint rules, then there are phase outs of the deduction and you have to do separate calculations. In addition, there's certain specified services that by their nature don't qualify unless, again, your income is below $315,000. Now, the important thing here is that you're looking at the income of the investor, the individual owner. You are not looking at the income of the entity. So you could have a rental property that generates $1 million of income, but if there's 10 equal owners, then each owner gets $100,000 of income allocated to them, and assuming that's all that they have on their return, they don't have to worry about any other limitations. They'll get a straight 20% reduction in their taxable income. So there's a lot that goes into this. So additionally, you have to look at each business separately. So it's calculated separately for each qualifying business. And if you have one property, let's say you have 5 properties that generate income, 1 property that generates a loss, that loss is applied across the board pro rata based upon the income properties. The interesting thing there is that the wages and assets from that loss entity do not get counted when you're looking at your various limitations. So it's going to be very important as we're planning at year end to look at where our wages are being paid and whether or not those are going to count towards this 199A deduction. Now, as saying all that, there's also aggregation allowing us to combine multiple similar businesses, and we'll get into that a little later, but that can help to mitigate having one property with a loss that has all the wages versus other properties that have lots of income and no wages. And anything, if you have a net qualified business loss for a year, that loss gets carried forward to offset future income. future qualified income. So we've got passive loss carryovers, we have basis carryovers, we have at-risk carryovers, we have the new business loss rules that will be carried over. And this is just one more item that we're going to have to track and make sure we're carrying it over to the next year. So with that, we've come to polling question number 1. I'll give us about 30 to 45 seconds to answer that, and then we will move on to the next section. Okay, so looks like everybody got that one correct. So let's look at what qualified business income is. So this is income from a qualified trade or business, which is all trades or business except performing services as an employee. W-2s and guaranteed payments do not count as qualified. And there's certain specified service trades or businesses that are specifically excluded from qualified business income. Now, the interesting thing is the law does state that it includes all items of income, gain, deduction, and loss from qualified businesses, but the regulations, when they came out, they did limit it to only ordinary gains and losses. So to give you a context of that, with real estate, if you pay attention to your K-1s closely, you'll see that when you sell a piece of real estate that you've been using as a rental property, the gain is recorded as a 1231 gain. So that gain gets taxed at capital gains rates. So therefore, it does not qualify for this deduction. However, if you have a low performing property and you actually sell it at a loss and have a 1231 loss, that loss does reduce your qualified business income because the loss is treated as an ordinary loss. So that's important to know as you're going through and working with your accountants to calculate your qualified business income. So let's look at the specified trades or businesses that are specifically excluded. And these are services in the field of health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, financial services, and then I have highlighted brokerage services or any trade or business where the principal asset of the trade or business is the reputation or skill of one or more of its employees. So before I get to that, I want to say that even though engineering and architecture are included in those in that definition, a separate section did exclude them from being excluded from the deduction. So if you have engineering and architecture services as part of your companies, those will qualify. So looking at the highlighted areas of brokerage services and a skill and reputation of one or more of its employees, the regulations were very favorable to real estate when it came to those. The first thing that we were concerned about was brokerage services, and if you have a real estate brokerage license and you're collecting acquisition and commissions and fees upon disposition, would you be excluded? The good news is that the IRS said no, we are looking at securities brokerage, not real estate brokerage. So that's the first benefit to real estate that came in there, and it was very specifically stated. The second item is the reputation or skill of one or more of its employees. We were concerned that that was going to be the catch-all, that was going to be where the IRS got you when it came to limiting the ability to take this deduction. Well, the good news there is the IRS actually went very narrow in defining that exclusion. And basically what they said is, we're talking about celebrities and famous people who are licensing their likeness, they're licensing their endorsement, they are making money off appearances, and I call it the Kardashian clause, where they just get money because they put something on Instagram. That income does not qualify. Now, the interesting thing is, looking at, say, a Gordon Ramsay, who owns restaurants and also does television and other appearances, they specifically addressed that and said, even though the restaurants may be famous for his name, at the end of the day, the restaurant itself is a qualifying business, but the money that he makes off of licensing and television appearances is not qualified. So that was probably one of the biggest areas that we were very thankful that the IRS was favorable to the real estate industry, because it also means that your management companies will qualify, even though really if you're third-party management, your ability to get new properties under management is based upon the reputation and skill of the employees. So that we were really worried about that when it first came out. So moving on to, so that being said, almost all of your real estate, whether it's owning and operating apartment complexes, will qualify. Your management companies will qualify. Your brokerage companies will qualify. Your development companies will qualify. So in real estate, you're generally going to qualify across the board as long as you have income. Well, another area that the IRS had to address was situations where you have a management company that manages the properties, and then you have separate properties that are their own operating entities. And it would not be favorable to have an operating entity with no wages, because the wages are all paid at the management company, and having a management company that pays all the wages and may have very little income, and treating those as separate businesses that have to be reported separately, and you would be limited at the operating entity level. So the IRS said that you can aggregate them together, and we'll look at the rules in a minute. The one thing I do want to point out is, again, this is another area where it's going to require separate rules than what may be done currently on your tax returns. Many real estate developers and owners have made the election to aggregate their rental properties into one, or consider their rental properties one activity for purposes of deducting losses. And what it's done is by designating yourself a real estate professional, you can deduct the losses as non-passive, where they may generally be considered passive to other investors. So even though you may have made that election, we're going to look at, you may not have the same aggregation. So to aggregate different businesses, the same person or group, and they do not define group, whether that's, they don't say if that's 10 people or 50 people, but the same person or group directly or indirectly own 50% or more of each business. And that's, again, looking at family attribution. So siblings, children, parents, those are all considered related and one group for purposes of aggregation. Now, the key there also is that the taxpayers who aggregate businesses don't have to own that 50%. All you have to do is show that there is a person or group of people who own 50% of each business. So that's going to require a lot of looking at organization charts and figuring out what businesses qualify and which businesses don't. So the ownership has to be similar for the majority of the tax year. The businesses have to share the same tax year. None of the businesses are excluded trades or businesses, which we've talked about real estate. Almost everything will be includable. And it satisfies two of the following three requirements. The businesses are the same or customarily offered together, which that you're looking at your management company and your operating entity where they are very similar. The businesses share facilities or centralized elements such as personnel, accounting, legal, human resources, etc. Well, that's, again, your management company, your operating entities, but then it's also looking at your multiple operating entities as sharing centralized resources, and that they're operated in coordination with each other. So again, you have one central management that's operating multiple businesses. The key here is that while the real estate professional election aggregates all your real estate, this may create multiple aggregated businesses for purposes of the deduction. You may have your personally owned portfolio that qualifies to aggregate as one business, and you may have other outside investments that you've made in real estate with other groups or families that those would qualify separately. So even though for purposes of the real estate professional election, they're all one activity, they are treated separately for aggregating under 199A. So the aggregation is done at the owner level, and that means that you could have one owner who aggregates his properties and one owner who chooses not to. It varies depending on the type of income, the type of owner. If they're passive investors, they may not need to aggregate because they've got passive carryovers and don't have a need to aggregate for purposes of this deduction, and they may have losses. But if you choose to do the aggregation, it is an irrevocable election, and each year you must attach to your tax return the description of each business, what it does, the name of each trade or business, and tax ID number. If you acquire new properties that you're going to aggregate or dispose of properties that have previously been aggregated, and the failure to make that election and properly disclose those activities could cause the IRS to void the aggregation, and that's going to be something under IRS examination that they would do. Similar to a real estate professional today who gets audited and they ask to see that election, the real estate professional election, this is going to be another election that they will ask to see if you choose to aggregate your businesses. And they have the ability to void that aggregation if you cannot supply it. So once you do that, now you are combining all of the income, all of the wages, and all of the assets into one aggregated business level calculation. So going on now to some of the limitations. So remembering the limitations, it's 20% of taxable income or QBI or the greater of 50% of wages or 25% of wages plus unadjusted basis. So the wages limitation is only actual W-2 wages paid by the business. And when they say W-2 wages, they really mean box 1 plus any of the box 12 wages, such as retirement plans or health savings accounts, or some of those items that, even though they're not taxable for federal purposes, they still count as wages. So the wages and wages paid by a common paymaster are allocated to the business the employee actually works at. Now, this is important for really the third-party management. When you have third-party management, you may be paying wages for employees working at a property that is not part of your personal portfolio. Those wages are going to get allocated out to those properties, and they will come off the W-2 wages for the management company. So that is something to pay attention to, because that could create issues at the management company level, depending upon your level of wages that are going to get allocated to third-party properties. And so the IRS did give a few little methods for doing this. They have the box 1 or box 5 of all W-2s filed with Social Security. It is the total wages in box 1 plus the modifications, or a specific employee by employee tracking of wages. The key there, and we've already had clients come and ask us, is, well, can't you just take my wage expense on my trial balance, add the prior year accrued wages and subtract the current year accrued wages and get a number? And the answer is no. The IRS is very specific that it is actual W-2s filed, and they're looking at that when they're doing your comparison. So another thing that we will be asking for each year is, at a minimum, the W-3s that are filed, but we may also need to get copies of all the W-2s, especially if we're going to have to split up and allocate W-2 wages across multiple properties. And it's also going to require us to meet with you to go over where these employees are actually spending their time. One of the other items that's important to look at is, if you have an S corporation, the W-2 wages paid to the owner's shareholders do qualify as W-2 wages. Now, where that's important is that guaranteed payments to partners, as well as income to owners of sole proprietorships, does not qualify. So even though guaranteed payments to partners are treated similar to wages, they don't count towards the qualification. So that creates a problem. Let's look at, you have A and B with similar businesses. Neither business has any employees, but A is a sole proprietor and B is an S corporation. Before salaries, each has $1 million of income, but B pays a salary of $290,000 to himself as the owner. So A gets no deduction because she has no employees and is a sole proprietor. B, however, does get a deduction of $142,000. And that's calculated, you take the $1 million minus the $290,000 of wages and multiply that by 20% to come up with $142,000. So both of their taxable income is $1 million. I'm sorry, both of their adjusted gross income is $1 million, but B's taxable income is only $858,000. Assuming no other deductions, we're just going to look at this income. At the highest 37% rate, B is going to save $52,540 in taxes. That doesn't seem fair, clearly. Just because A cannot pay salary to herself, and even if A were a partnership, she could only really pay guaranteed payments to herself. So she still would not get any deduction. That's another thing to note as we're preparing tax returns. Many companies, and I don't know everybody's situation, but many companies are partnerships, and just for administrative purposes, they keep the owners on a W-2. Just because it's easier for the payroll company to manage benefits. It's easier for the some of the minority holders who are employees, such as accounting, CFOs or presidents of development. It's easier for them to have a W-2 because it's what they're used to getting. And so you never really transition them to guaranteed payments. If that is the case and owners are receiving W-2s, we will have to reduce the W-2 wages for the 199A reporting by those owner payments. So that's something to pay attention to, and it's something to consider whether you need to change to an S corporation or not. So that's a situation where if you have a significant amount of income, the S corporation owner is at an advantage. Let's look at a situation where they both have, again, similar businesses, neither as employees, say sole proprietor and S corporation, and now instead of $1 million of income, it's $200,000 of qualified income. And B pays a salary of $80,000 to himself as the owner. So under this situation, because assuming there's no other income and they're both married, they're below the $315,000 taxable income threshold. A gets a deduction regardless of the W-2 wages. So A is going to get a $40,000 deduction, 20% of $200,000. B's deduction in this case is only $24,000. Again, $20,000 of income less $80,000 of wages times the 20%. So A's taxable income is the $160,000, but B's is $176,000. And so in this situation, A saves taxes. Now, I think that was an unintended consequence of the rules and the law. However, that's going to take a correction by Congress to fix. That is not something the IRS can address in regulations because the law was specifically written to exclude guaranteed payments. And while I believe what the intent was is that W-2 wages and guaranteed payments to owners were not able to reduce or create a 199A deduction, by allowing the wages of owners to be included in the wage limitation, they inadvertently allowed certain S corporations to get a deduction that was against what a partnership or sole proprietor could do. So whether that's on Congress's radar or not, that's unknown. The IRS, though, has specifically said to Congress that there are areas of this law that have to be corrected by them and cannot be corrected through regulations. So that's important to pay attention to and to show that things may still change down the road. So that's the W-2 side of things. The other side is this unadjusted basis immediately after acquisition. So what that means is tangible property subject to depreciation that is held by the qualified trade or business and in use at the close of the taxable year. Its depreciable period has not ended before the close of the taxable year. However, even though the depreciable period has ended for lower lived assets, you still get to count their cost basis for 10 years. And then for your buildings and your land improvements that are 27.5 for multifamily, 39 for commercial, and land improvements at 15 years, you get a full 15 years depreciable life to count those assets. So what that also means is that land does not qualify. So we're looking at just your depreciable cost basis. And if you contributed property to the partnership, it does have a carryover basis. And if any gain was recognized, you increase the basis by that gain to the contributing partner. So again, not making things easy, there are various exceptions to this rule, and some of them, in my opinion, don't make a lot of sense. For instance, property that is inherited from a decedent will have a basis equal to fair market value at the time of death. That makes perfect sense. That's the step up in basis that the decedent gets when they inherit, or I'm sorry, the heirs get when they inherit property from a decedent. But if you look down a few, Section 754 adjustments otherwise do not qualify. So these are adjustments made when you have new partners enter a partnership and they purchase interests and they get a step up in basis for their acquisition cost. I don't know why they decided to distinguish between inherited property and purchased property, but unfortunately 754 purchased property does not qualify for UBIA. For like-kind exchanges, if you have a property that was like-kind exchanged, then the beginning qualified basis is the net basis carried over plus any additional basis. The interesting thing there, though, is even though you may start your depreciation over on the old basis, the in-service date remains the original in-service date of when the relinquished property was purchased. So that is going to, again, require for really, if you're looking at assets that are coming close to their end of their useful life, you're looking at having to calculate the in-service date to determine whether or not that basis qualifies. One of the things that was not addressed is if you had a prior year technical termination. Now, even though the new tax reform eliminated the technical terminations for partnerships, under the old rules, if you had a technical termination, meaning more than 50% or more of the ownership changed during a 12-month period, you started the depreciation over using the adjusted basis at the time of the termination. The proposed regulations that came out did not address that situation specifically. However, I do think that they would anticipate following the like-kind exchange rules in which you would use the adjusted tax basis at the time of the termination, but you would still have to figure when the property is placed in service. So those are some key items to think about with unadjusted basis and what that means. All right. Here's polling question 2. Okay. Thank you all for answering that question. And again, everybody got it right. You see, we're not trying to trick anybody. We just want to make sure you're still paying attention. Okay, so let's pull it all together and look at an example as we wind up with the 199A deduction. So for this example, we have an S corporation with QBI of $800,000 and pays $100,000 in wages, a partnership with rental income of $1 million, no wages, and rental property with an adjusted basis of $10 million. And then we've got $75,000 of wages in the S corporation for employees working at the rental property. So you have, again, you've got your QBI for the S corporation. You have $800,000 of QBI. Your wages are $100,000. So your first limitation is $50,000 of wages, or 20% of the QBI. So in this case, because 20% of $800,000 is higher than the wage limitation, it's limited to $50,000. Because the management company does not have any assets, the limitation is 25% of wages, which is $25,000. In the management company itself is going to get a $50,000 deduction. So now let's look at the rental property. So the rental property, again, you've got $1 million of QBI, $10 million of qualified property, wages of $0. So you go through and 20% of $1 million is $200,000, but you have 0 wages, or you have 0 wages plus 2.5% of the property's $10 million, which is $250,000. Now, because the $250,000 limitation is higher than the QBI limitation of 20%, you get a $200,000 deduction. And if anybody's wondering where they came up with 2.5%, that's basically depreciation on a 39-year property is 2.5%. So that can be used as a good estimate if you're trying to do your own calculations. So now let's aggregate. So if you remember, the management company originally had $50,000. The operating property had $200,000. So if you did not aggregate, you got a $250,000 deduction. Well, now we're going to aggregate and allocate $75,000 of wages to the operating entity. We're aggregating everything together. So if you take the $1 million of QBI plus the $800,000 of S corporation income, you're going to come up with $360,000. 20% of that is $360,000. Now, once you go through and calculate your limitations based on wages and qualified assets, you come up with $275,000 as your overall limitation, because you get the $25,000 of wages plus the $250,000 of property. So as you can see, by aggregating, you're getting a more beneficial deduction. Okay, so that's the basics and high-level review of Section 199A. Let's give you a few updates on other provisions, because the IRS has been putting out a lot of information over the past couple months, and it's coming out pretty quickly, and I want to hit on a few things. So one of the things, if you're in Georgia, There's the gold credit and the rural hospital credit. In the past, you were able to donate to those funds and receive a charitable deduction as well as a state credit. Well, for any payments made after August 27th, 2018, you will no longer get the federal charitable deduction. So you only get a state credit. And the payment goes against your $10,000 state and local tax deduction limitation. So for most of the goal for 2018, you're going to get the charitable deduction still. Where this will impact you is if you're in Georgia, the rural hospital credit is being opened back up, but you're not going to get the charitable deduction. You're only going to get the state credit. The next thing is meals and entertainment. Entertainment expenses became 100% non-deductible. And the question arose of, if I take a client to a Braves game, is the entire expense non-deductible, or do I still get to take 50% of the meals? So the IRS stated that if you can separately identify the meals from the entertainment price, so the cost of the tickets is non-deductible entertainment. However, the food, if we go to the concession stand and get a hot dog, or if we're at a Falcons game and we've got a suite and we have to pay for the food separately, the food piece will still be 50% deductible. So that was important. Here's the big one. There's a 30% limitation on interest as it relates to deducting interest from operating entities. You're limited to 30% of your EBITDA. Real estate has an exclusion in that says if you want to deduct 100% of your interest, you have to elect to have a 30-year life for your multifamily, or a 40-year life for your commercial building, and a 20-year life for your land improvements. Well, here's the big kicker to that. If you make that election, there is talk that you have to do a change in accounting method. And because bonus depreciation was not allowed under what was called ADS, the Alternative Depreciation System, any bonus depreciation you took on 15-year property would have to be recaptured as income as you recalculated your depreciation expense. Another thing that was important in that is that while Congress said 27.5-year property goes to 30 years, which is not a big deal, and obviously 39-year property going to 40 is not a big deal, there actually was no provision in the code for a 30-year life. So it's possible that instead of going from 27.5 years, you have to go to 27.5 to 30, you actually have to go from 27.5 to 40. And again, the question that we don't know the answer to, but we have to prepare our clients for, is that you may have to recalculate all of your depreciation if you are going to elect to deduct interest 100%. So that's a huge thing that we're still waiting for the IRS to address. And there's various thoughts on that. Hopefully the IRS will take the path of least resistance and just say that it is a change moving forward. But again, it could be one of the areas where they say, we got you, and we're going to make you pick up all this income over the next 4 years. If you make that change in accounting method, you pick up 25% over the next 4 years. The next thing is the carried interest rule. So one of the things that came out about that was, will promotes be subject to a 3-year hold? There is more and more traction being gained that real estate gains, as we said earlier, which are 1231 gains, will not be subject to the 3-year hold. Now again, that could all change when regulations come out. But as of right now, I think we're going on the belief and really the hope that that's not going to be subject to the 3-year carried interest rule. So those are some quick provisions. I'll add one more that just came out Monday. Opportunity zones, I'm sure you've heard a lot about. The proposed regulations came out on Monday. We're still digesting them and going through them. However, we have found that they were very favorable and do allow for a lot of favorable investment into these opportunity zones. So please make sure if you're looking at these that you're contacting your tax preparer. So this is a slide that I gave back in January when we talked about the reform in general, but the clarity is coming out. So the Blue Book will be published shortly, we hope, and that will clarify congressional intent, but it has not come out. The regulations are starting to come out, and they do have 18 months from the December 22nd date in which this was made law to issue regulations and make them retroactive. They have been putting out interim notices such as the meals and entertainment and the state taxes, which didn't require full regulations but still gave us some clarity. So those have come out. And then, as we talked about, there's technical errors within the legislation as it was originally passed that have to get passed by Congress. Unfortunately, I anticipate, because we're coming up on midterms, there will not be anything done before the end of the year. And depending upon how the midterms come out, there may not be anything done opening up 2019. So there may still be a lot of changes that come out, and there could be also a lot of uncertainty as we go into the 2018 tax return preparation season. So if you want to speak with an expert, obviously we have many people here at the firm. Contact your tax preparer or reach out to myself, and be glad to consult with you and find out if you think you qualify, what will qualify, and how it will look. So here's the last polling question. All right, so the correct answer is guaranteed payments to partners are not allowed when calculating wages for the 199A deduction limitation. So, so with that, are there any questions? There are a few that have been put through the dashboard, but feel free to put any more through. One of them being, how is all this going to be reported? Well, the way it is set up now, the IRS has issued draft Forms K-1, and if you remember how the domestic production activities deduction information was reported on the K-1s with separate line items it was line 13 at that time, but the draft K-1s for 2018 have all this information being reported as separate other information on the 2018 tax returns. So that's how all the partners will get the information. If I have less than $315,000 of income, do I still need to figure the limitation? Yes, you do. The reason why the limitation amounts do have to, the reason why the limitations have to be calculated is because just because your business has less than $315,000 of income, you may have investors with higher amounts, and they're going to need to know that information. Do Schedule E rentals owned 100% by an individual qualify? That's trickier. So the way that the law is written, it says that the business has to qualify as a trade or business. rental property has always fallen into this nebulous area of, is it a trade or business? And that's specifically because by its nature, rental income is considered passive, or rental income or loss is considered passive by its nature, and you have to prove facts as to whether or not it is a trade or business. Now, I do believe that most properties will qualify because there is a motive and a profit motive involved. But unfortunately, we may have a situation where owning a rental property on your Schedule E individual return does not reach that threshold of being considered a trade or business. Comments have already been made to the IRS to try and clarify that in the updated proposed regulations, because these have not gone final yet and they are still taking comments. So it really is a facts and circumstances, unfortunately, because they did not put a bright line test for rental properties. How long are losses carried forward? So losses are carried forward indefinitely. However, this provision does end in 2026, I believe. So barring extension by Congress, those losses could just expire at the end of 2026 and go away, and there'd be no benefit for the deduction moving forward. Hopefully it'll be extended. But so that's all the questions. I want to thank everybody for participating, and hopefully if you have any need, or talk to your tax advisor, or feel free to reach out to myself. I've got my phone number and my email address on the last slide. So thank you everybody for attending.